When you think about defense technology, what comes to mind? Probably big things, right? Tanks, fighter jets, that kind of stuff. But today, we're diving into a company that builds the critical eyes and ears for all of that hardware, Paras Defense. They've carved out a niche so important, they're practically a monopoly. So let's get into what that really means for an investor. So here's the multi-million-dollar question, isn't it? We have a company with a near monopoly in some super critical areas of defense. But is it a smart buy at its current price of around 809 rupees? That's the puzzle we're going to solve today. Let's unpack the data. All right, let's not bury the lead here. We're getting straight to the point. Our final verdict on Paras Defense is a hold/watch, with a score of 58 out of 100 and a fair value range we see between 850 and 1,000 rupees. It's complicated. The rest of this explainer is all about the why, how we landed on this conclusion, starting with a very, very strong bull case. So, what's all the excitement about? Why are so many investors drawn to this company? Well, it boils down to one powerful word: moat. We're talking about a business that has built such massive walls around it that competitors can barely even see inside. This right here, this single sentence, is the heart of the entire bull case. You see, when it comes to the incredibly complex optics for things like submarine periscopes or the cameras on satellites, Paras is the only private player in India that can do it all, from start to finish. Just think about that for a second. For their customers, switching to someone else isn't just a hassle, it's pretty much impossible. And here's where that incredible moat turns into incredible money. Their revenue is split almost 50-50 between two big divisions. But I want you to look closely at the defense and space optics segment. That is the crown jewel. It boasts a 54% EBITDA margin. Now that's just a fancy way of saying it is wildly profitable. For every 100 rupees they bring in from optics, about 54 rupees is operating profit. That's the engine that could seriously supercharge this company's future. And the story gets even better. There are four massive pillars supporting this bull case. First, they're exclusive suppliers to huge government bodies like ISRO and DRDO. Second, the government's whole Make in India initiative is like a powerful wind at their back. This all adds up to a huge order book of around 1,000 crores, which gives them clear revenue visibility for years. And you know who's noticing? The big institutional investors who have more than doubled their stake. Okay, I know what you're thinking. That sounds fantastic. An unbeatable moat, huge profits, what's not to love? But, and this is a really big but, a great story has to be backed up by great numbers. So let's flip the coin and look at the bear case, because there are some pretty significant financial hurdles we need to talk about. This brings us to what might be the single biggest red flag: return on capital employed, or ROCE. Now the concept is simple. Is the company making more money on its investments than what those investments are costing them? And for Paras, well, the answer is no. They're getting a 12.6% return, but their cost of capital is around 15%. To put it simply, that's like borrowing money at a 15% interest rate and then putting it into a bank account that only pays you 12.6%. You're actually losing money on the deal. It's not a sustainable way to create shareholder value.
And you can see that financial strain pop up right here when you look at their free cash flow, the actual hard cash left over at the end of the day. As you can see, the company has actually been burning cash, with 2 of the last 3 years in the red. Now, this is mostly because they're investing heavily in growth and because it takes a long time for their clients to pay them. That's a key trend to watch.
So, let's quickly sum up the bear case. First, the stock's valuation is steep, trading at almost 80 times its earnings. That's pricey. Second, getting paid is a slow process. It takes them on average 289 days to collect cash after they make a sale. That's almost 10 months. And finally, all of this adds up to that negative free cash flow we just looked at. The story's exciting, for sure, but the cash situation is a real concern. So we have this incredible bull story on one side and a pretty worrying financial picture on the other. It's a classic tug of war. So how can we check for any hidden issues? Well, we can run the company through a few standard financial health screens to see what the numbers really tell us.
First up is the Piotr F-score. Think of it as a 9-point health checklist for a company's finances. Paras scores a very strong 8 out of 9. What this tells us is that despite the cash flow issues we just saw, the underlying business is actually getting healthier and stronger. That's a great sign.
Next up, the Altman Z-score, which is a tool designed to predict if a company is at risk of going bankrupt. Now, any score above 3 is considered safe. Paras scores? A 43. So yeah, while cash flow might be a concern, the risk of this company going bust anytime soon is basically zero. And finally, the Benish M-score.
This one helps us sniff out any potential accounting manipulation. Here, a negative score is a good thing, and Paras comes in at negative 2.55, which is well inside the clean zone. This gives us confidence that the financial challenges we're seeing are real business hurdles, not something cooked up in the accounting department.
Okay, let's bring it all home. We've got a company with a brilliant strategic position, but also some very real financial growing pains. How in the world does all of that translate into a fair price for the stock? Let's figure it out. This table really helps lay out the possible futures. In a bear case, where they stumble on execution, the price could easily fall to the 550 to 600 rupee range. In a fantastic bull case, where new ventures like semiconductors really take off, we could see 1,200 or more. Our base case, assuming they just keep growing like they are, puts the fair value between 850 and 1,000. And here's the most important part. Today's market price is already assuming that base case happens. There's no margin of safety priced in.
And that really gets to the heart of the investment decision you have to make. At today's price, you are not buying a bargain. You're paying a full and fair price for the promise of steady growth. For your investment to be a big winner from here, you need to believe not just in the steady story, but in that breakout bull case scenario actually coming true.
Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit that subscribe button and press the bell icon so you never miss an update.
And now I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might just be the subject of our next explainer. Thank you for watching, and keep your investing stress-free.